You have a year-end target of above 4,000, 4,200. It's just we won't get there right away.
That's right. We think that in the first part of the year, we still continue to face a pretty fair deal of headwind on the earnings side. Margins, we think, remain under a heavy dose of pressure. A backdrop where you have goods deflation, probably also soon enough service-based deflation, but at the same time, wage inflation remains quite sticky. I think that's a pretty bad combination for margins. I think expectations are simply still too high. You know, even if you look at simply the 10 largest companies within the S&P 500, expectations are calling for 10% earnings growth for next year and 1%, sorry, this year, and 1% margin expansion.
Now it's this year. Funny the way that works, Dubravko. So what do you, and the Fed stays restrictive, so that means
initially,
which means that multiples have no reason to expand.
Right.
Lower margins, lower earnings, lower multiples on what S&P total for the year, do you think?
So we think EPS basically moves lower towards 200, 205. 205 is our EPS estimate.
Times 18?
Yeah, I think you could put times 18 right now. That brings it to about a 3,600 level at some form of fair value. But then I think if the Fed starts to signal some form of easing, as inflation continues to make more progress, let's say middle of the year or second half of the year, that's when I think you could actually start seeing multiple expansion, including in some of the most beaten up equity segments, which is obviously tech and a lot of these hyper growth names.
So you think easing, though, not just a pause? Or
I think a pause is not enough because I think we're already too restrictive.
So can I ask a terrible timing question? Yeah. Everybody's, you're never supposed to time the market, and everybody's now going to listen to what you're saying, and they're going to say, if it's going to end the year in this better place, maybe I should just, do it now, effectively.
Netflix,
and I'll get there that way.
Things are cheap.
Or if I'm really greedy, I'm going to wait for these lows to be tested the way you described. Whether they come or not, we don't know, obviously. And then if he's right, I'll do even better. But what's the better path?
It's a tough one. Like, what I will say is that people tend to think about the market through like some form of normal distribution, but we think this year will end up being another, call it non-linear year. I don't think the Fed is going to, make it easy for the market. They will probably stay restrictive for too long. Right. That's going to continue to result in a flush. I think you're seeing a lot of retail money coming out of the market, a bit of a panic. Look at about $1 trillion wiped out of crypto, $1 trillion almost wiped out of Tesla. As the panic starts to build up, market basically faces new lows, and then at some point the Fed may actually start to ease.
I think if we knew, you say, well, test the lows. Do they hold? If you knew that it was going to be just a test, then you would buy here. I think because it's we're at 38.25 or whatever on the S&P. What do you see the lows? 35.80? Is that where the lows were?
36, 35, 50, yeah.
So do we go to 32 and wait for that? Or if all we do is test the lows, you could buy some of these stocks now.
I think that on the institutional side, when you look at the data, there has been already a pretty heavy unwind. So I do think institutional positioning is quite low. I think retail is the area of vulnerability. So yes, I think you get to a 35, 36, panic starts to basically increase, but you will start to see some institutional smart money stepping in. So again, 36 we think is at a minimum. Market could go somewhat lower. How low?
36 is a minimum.
I think, yes.
So that's another.
In this backdrop.